$500 billion. That is the jaw-dropping amount of capital being mobilized in a historic tech deal announced on August 10, 2026. Welcome to TrendGuards. I'm your host, and our mission here is to deliver accurate, verified, and well-sourced analysis. So today, we're cutting through the noise to bring you a strict, hype-free explainer on the largest capital mobilization in tech history.
Let's jump right into the most important confirmed fact of this whole story. NVIDIA is setting up dedicated infrastructure financing platforms designed to mobilize over $500 billion in third-party capital. Now, to be incredibly clear, this isn't NVIDIA just emptying its own bank accounts. We're talking about external capital, Wall Street money, flowing directly into the physical foundation of the AI boom.
So, whose money is it exactly? Well, according to NVIDIA's official newsroom and reporting by CNBC, NVIDIA has signed preliminary agreements with 6 absolute titans of finance. We're talking Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR. The goal here is simple but massive. Fund the intense physical footprint required for AI, which means massive data centers, the power plants to run them, and the compute systems themselves.
What's really fascinating here is exactly who gets to use this massive pool of money. As CNBC reported, this cash isn't just earmarked for the mega hyperscalers like Google or Amazon. It's actually set up to allow frontier AI labs and regular enterprises to finance insanely expensive physical infrastructure completely off their own balance sheets. And it covers the whole shebang: computing systems, networking, power, and cooling. Because, as NVIDIA CEO Jensen Huang has pointed out, the biggest bottleneck right now isn't actually getting the chip itself. It's building the physical factory required to run it. So how does this work in reality? It's basically a 4-step process. Step 1, the financier, think Blackstone or KKR, provides the raw capital. Step 2, the physical data center infrastructure gets built. Step 3, that infrastructure is leased out to those labs and enterprises we just talked about. And finally, Step 4, those lease payments turn into predictable, steady cash flow that goes right back to the investors. The financiers own the physical infrastructure, which essentially turns a highly volatile tech build-out into something that looks a lot more like a traditional real estate or utility investment.
The absolutely crucial number you need to remember here is 25%. To de-risk these gigantic deals for Wall Street, NVIDIA may provide what they call residual value support for up to 25% of each opportunity. And based on reporting from groups like Constellation Research, it's important to note this is assessed strictly on a project-by-project basis.
To put that in plain English for us, NVIDIA is actually using its own balance sheet to guarantee the loan collateral. If those financed GPUs lose their resale value faster than anyone expects, NVIDIA is on the hook to cover up to a 25% shortfall. They are intentionally acting as a shock absorber, taking on a quarter of the downside risk so that the big financial firms feel safe enough to take the first loss risk on the remaining 75%.
TechCrunch recently called this financing plan risky but brilliant, and here is exactly why. Standard GPU financing terms usually run for about 24 to 36 months. The problem? NVIDIA drops a brand new, vastly more efficient silicon architecture roughly every single year. So older chips depreciate incredibly fast. It's like buying a car that becomes obsolete before you even finish paying it off. Because of that steep drop in value, lenders face massive collateral risk. Without NVIDIA stepping in with that explicit 25% guarantee to prop up the residual value, the cost of borrowing money to build these AI centers would likely be way too high to even make sense.
But this whole framework really supports one very specific vision. Over on LinkedIn and the NVIDIA blog, CEO Jensen Huang stated, NVIDIA AI factory compute is becoming an investable asset class. He's making the argument that an AI factory shouldn't just be viewed as a pile of rapidly depreciating hardware. Instead, he wants it to be priced, financed, and traded as a durable, reliable infrastructure asset. Think of it less like a laptop and more like a toll road or a power plant. Now, as impartial analysts here at TrendGuards, we have to present both sides of what Wall Street is currently arguing. On one hand, the bulls see this as the ultimate build-out supercycle, a brilliant move connecting patient institutional money to the greatest infrastructure need of our generation. On the other hand, critics are waving red flags about a potential circular financing bubble. They're concerned. They argue NVIDIA is effectively backstopping the very assets that are buying its own chips. Now, Huang has explicitly denied these circular financing claims, but it's a very real debate happening in the market right now.
And if you're wondering why this matters directly to you, well, Fortune magazine bluntly warned that your retirement money is now officially exposed to the AI boom. Firms like BlackRock, Blackstone, and Apollo manage trillions of dollars in assets, including teacher pensions, firefighters' funds, and everyday 401ks. If this AI sector overbuilds and the utilization of these data centers drops, the resulting financial hit could flow right into the retirement portfolios of millions of everyday citizens.
Breaking this down across 3 key sectors, the ripple effects are huge. First, in the chip sector, this framework helps lock in over $500 billion in orders through 2026. That puts an intense amount of competitive pressure on rivals, like AMD. Over in the cloud sector, it eases the immediate capital expenditure burden for providers, since they can just lease the hardware instead of buying it up front. But long-term, it risks flooding the market and turning raw compute power into a cheap commodity. Finally, for stocks, NVIDIA successfully offloads a massive chunk of credit risk to Wall Street. But remember, they are adding a 25% contingent liability to their own balance sheet if GPU values happen to crash.
At TrendGuards, we prioritize clarity and truth, so it is absolutely critical that we strictly separate what is a verified fact from what is still up in the air. The confirmed facts are solid. 6 major financial partners have signed preliminary agreements. They are officially targeting a $500 billion capital mobilization, and NVIDIA has that 25% project backstop limit. However, the unknowns are equally important. These terms are still unfinished. They aren't closed transactions yet. Plus, NVIDIA itself has explicitly warned that these arrangements could potentially reduce their near-term cash flow and increase their overall financial exposure.
So, what does this all mean? We are left with the ultimate question. Is this a brilliant supercycle accelerator that's going to build the physical future of AI, or is it a circular financing bubble exposing your hard-earned retirement money to the rapid depreciation of graphics cards? Whether this is a true infrastructure boom or just some very complex financial engineering, the reality is that your retirement fund is now participating in the AI build-out. I'd love to hear your take on this. Let me know your thoughts and analysis down in the comments. Thank you so much for joining me for this explainer. As always, we value accuracy and clarity above hype, and we'll see you in the next one.
Thanks for watching. Don't forget to like, subscribe, and share. It really helps the channel grow. See you in the next video.